We use transport every single day, whether it's by car, bus, train, ferry, plane, animals, or even our own 2 feet. Transport helps us move from one place to another. The type of transport we take usually depends on where we are going, the distance and time it will take to reach it, as well as the options available to us. Our cities, towns and suburbs are all connected by roads. Roads have existed for thousands of years, but the kinds of transport available to us now allow us to travel much faster than back then. Cars, motorcycles, buses, trucks, and trains transport goods such as food and building materials, as well as us. The best way to travel really long distances is by air. Aeroplanes allow us to travel across countries easily and quickly, while small helicopters can help in emergencies and rescue operations like bushfires, forest fires, floods, or earthquakes. Travelling by water used to be very common before planes. People used to travel to other countries using boats, which would sail for months at a time. Now, water transport is mostly used for enjoyment, such as cruise boats and yachts, or for trade, such as cargo ships and oil tankers. Transport has changed significantly over time and continues to get faster and better. Can you imagine what life was like before all of the technology we use today was invented? What do you think life will be like in the next 100 years?
What do you know about risk? Risk is the probability of an outcome having a negative effect on people, systems, or assets. Risk is typically depicted as a being function of combined effects of hazards, the assets or people exposed to hazards, and the vulnerability of those elements. Risk is everywhere. Risk is somewhat a lesson to us to grow and do better in our jobs and even in business. Taking risks making us stronger and confident because we know that if we take risks, we want to explore and do the jobs, whether the result will be good or bad. In addition, when we want to export goods in other countries, we must take note that risk is always existing. We must also think of ways we can overcome those risks. There are many risks which arises during the shipment or delivery process. Whenever a cargo or stored in transit by road, rail, air, or sea, it could be damaged, lost, or stolen. The loss of goods or equipment is likely to be costly for their owner as the cause of dispute between the buyer and the seller. Exporting goods using cargo, damages done to containers by loading, various ship malfunctions, fires, rollovers, accidents, stranding, drowning, dangerous air conditions, cargo becoming wet, cargo being washed off the deck, or being forcibly thrown overboard are the main risks of sea transportation. So we must think of ways we can do to overcome the risk. That's why there are risk management. For us to know What are the ways we can do, and how can we manage if there is risk existing?
Examples of physical risk is goods damage in transit, loss and theft, roads in poor condition, and accidents. Goods damage in transit are some of the delivery that mishandled our packages, and some they just throw the package inside the truck. And lost or thief, this is some of the packages that are stolen or missing. The cause of this is something that they may follow from a carrier or the delivery van, and some may just stole your items. And the roads in poor condition. This physical risk is so common in some areas, just like the Bukid area, and having a bad road can be a hard time for the delivery because their van will be shaky, and so their goods and items in the van will be damaged, and especially the fragile one. And lastly, there are times that there will be accidents in their delivery, so our packages will be damaged or not be able to deliver.
Credit risk. Even if the goods arrive complete and undamaged, the problems do not stop there because there is a risk that the buyer will not actually pay for the goods. This may be perfectly legitimate in that there is a contractual dispute between buyer and seller. After all, the exporter may have shipped total rubbish to the importer. However, we must accept that non-payment may be the result of dishonorable intention of the buyer. This takes many forms, from non-acceptance of the goods through taking over the goods and deliberately delaying payment, to simply not paying for the goods. A consumer may fail to make a payment due to a mortgage loan, credit card, line of credit, or other loan. Example of credit risk. Consider a borrower who takes out of $300,000 home loan.
Cargo marine insurance general average. This is one of the oldest principles of cargo insurance and still has relevance today. It covers the situation where there is extraordinary sacrifice or expenditure intentionally and reasonably incurred for the purpose of preserving the imperiled property involved in the common maritime adventure. This will include situations where goods are jettisoned to save the ship or are damaged by water used to extinguish a fire, or the vessel is diverted to a port or refuge, and many other situations where loss of certain goods preserves the rest of the cargo and the conveyance. The basic principle is that all the parties involved, including the vessel owners, contribute to the loss. What is maritime cargo insurance? Maritime cargo insurance covers the risk of loss, damage, expense, and liability to your goods during transportation as cargo from one place to another place. For example, from a factory located inland to the seaport and then across the seas of the address of the buyer of the goods abroad. Why is cargo insurance important? It is for controlling all trade hazards, beginning at the point of cargo loading and continuing until the shipment reaches its destination. This policy covers the loss of damage of cargo consignment during the process of transportation from the port of origin to its port of destination. And then, who needs marine cargo insurance? A business involved in the international movement of goods needs insurance protections against the associated risk with the transportation of goods of shipments from one destination to another. And then, what is the example of cargo insurance? So, there are lots of examples about cargo insurance. So, daghan jud kayong example ang cargo insurance or maritime cargo insurance. So, like, sabotable naman siya. And so, I will give just a little bit of example. And then, it is If a load is accidentally dumped into a waterway or on a roadway, cargo insurance may cover the expense of removing debris. This type of insurance can protect against financial losses while goods are in transit during shipment on the way. So, for me, maritime cargo insurance is such a very important way of protecting your goods and assuring that your good or your product is being protected and has insurance that if something happens along the way, there would be you will get a chance to exchange your good for not a damaged one if it is damaged, by the way. But if it's not damaged and it's good and it's in good condition, then that is the perfect way that's possible. But this type of I'm explaining to you cargo insurance, maritime insurance. So this is the insurance where products is been replaced or protected during shipment along the way. So it is very important for you to have this kind of insurance. Di lang sa ato people, we need insurance, right? So ang products po need po siya insurance for us to assure that the product is going to be perfect and sealed, well packaged. So there are lots of sellers that may cover okay ra sa ila ibalik sa ila ilang parcel or ilang product if it is broken along the way. But there are dili tanan seller naay uban seller, especially from other countries, if your product is on your way, nana siya sa shipment process, dili na sila manghilabot. When they dispose the product, it's over. Their responsibility is over. They are not liable on exchanging the good because they know that the product they produce or they disseminate is good. Paghawa sa ilaha good, in good condition, and then the shipment is the issue. So naiuban na dili na nila wala na sila paki about replacing your product because they believe that the product that they produce is good. So napoy nga nga seller, and then napoy seller na mag-mind gid sila sa feedback silang customer. If their customer may message them that the product is broken, the product is not as intact as I was expecting, the quality of the product is not the what I'm expecting on the photos, on the then they will replace the product on a better one. So there are that kind of seller, pero napoy uban seller na wala gid sila paki if ever naay tipak or the fragile products should be handled with care, di ba? Dapat na ganun nakabutang fragile o ingana. That is the role of insurance dapat for me. Because if I were a seller, then siguro nagid dapat ko liable gid ko if my product is not working pag moabot na sa customer. Labi na if I know that my product is really has that quality. So di ko gusto nga i-downgrade akong product or akong business, madaot ang reviews because of the shipment. So that's a no-no. So for me, maong diha gid mo sulod ang insurances thingies kay importante gid kayo ang good feedback sa customer may reflect to your product or to your business. So that is important to me if ako ang seller. So that's it. I know that it is really dali ra gid siya masabtan, and then understandable na gid kayo kung unsa ang cargo insurance and maritime insurance. So me explaining to you further about it. So I hope you get some lesson or some understanding new knowledge about what is cargo maritime insurance.
Specific voyage policy. It is perfectly feasible for an exporter with an international consignment for shipment to approach an insurance company, invariably through an insurance broker, and request that an insurance policy be drawn up for that particular consignment. So this is often referred to as a voyage policy, as it covers only that specific shipment. An exporter approaching an insurer for a voyage policy would now receive a marine all risk policy, or MER, with attached clauses and pay the appropriate premiums. So as the name itself, a specific voyage insurance policy covers a specific single transit only. So it offers coverage to goods, freights, and other interests against various losses or damages.
Open policy. The most common situation is that expertise use a broker to approach insurance companies and agree the pricing of a policy which is drawn up to cover many shipments and not just one. This may be floating policy which is raised for a particular value and which gradually reduced by the value of each shipment until it is used up and requires the new one. This type of policy is less common than is used to be, particularly because the exporter is often to require payment of an average.
Open policy in risk management refers to a transparent and flexible approach where policies are accessible, comprehensible, and subject to continuous evaluation and adaptation. An example of open policy in risk management is safety protocols, clearly outlining safety procedures, emergency response plans, and risk mitigation strategies so that everyone is aware of what to do in case of a crisis. The goal of an open policy in risk management is to promote transparency, accountability, and trust, which can help a company build stronger relationships with its stakeholders and minimize reputational damage in the event of a risk-related incident.